TSLY, or the YieldMax Tesla Option Income Strategy ETF, is a pretty awesome ETF that utilizes an interesting synthetic cover call strategy in order to give massive distributions to shareholders. And as far as these distributions go, we're talking anywhere from around 40 cents on a monthly basis upwards to over $1, which is what we saw last year in July. But the obvious problem for investors that bought into TSLY over pretty much more or less any time frame since this ETF has been alive is that the ETF price just keeps dropping and dropping and dropping, so far to the point to where as of right now it's trading at around $10.90 per share. Now in this video, I'm going to explain an exact strategy that I've been using to not only benefit if TSLY's price moves up, but also to significantly benefit if TSLY's price moves down. And the coolest thing about this strategy is that you earn the dividends along the way as well. Now if this interests you at all, make sure to please drop a like down below and let's get into it. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first, just a quick little background on the TSLY YieldMax Option Income ETF, just the basics though, because we've talked about this ETF so many times on this channel, and if you happen to be interested in that, go back and watch some of my previous videos. So right here directly on the website from YieldMax, it says the fund does not invest directly into Tesla, which is the underlying stock that TSLY basically tracks or references to. It also says investing in the fund involves a high degree of risk because it uses a synthetic cover call strategy. Also important, says the fund strategy will cap potential gains if Tesla share increases in value. But also importantly, this fund strategy is subject to all potential losses if Tesla shares decrease in value. And as you can see here, because of the massive premium, the distributions on a monthly basis have been huge. Now just to recap, TSLY pays a massive distribution on a monthly basis, which could be extremely profitable for dividend-focused, income-focused investors to maybe even theoretically live off this cash flow with a small amount of money, relatively speaking, invested. To illustrate this even better, take $20,000 invested into something like TSLY as it sits currently at around $11 per share. This $20,000 invested into TSLY would buy an investor around 1,818 shares of it, as it sits currently. Now looking at all the most recent distributions, if we would go somewhere even in the middle to lower range, let's say a 60-cent distribution on a monthly basis, that $20,000 investment in theory, going off of some of the averages, would earn an investor around $1,090 per month in dividends, which of course is much, much higher than for the most part any other investment vehicle across the market when it comes to dividend income alone. But like we said during the intro, that doesn't really mean anything if your underlying investment is going to continue to decay like TSLY's ETF price has on the max time frame so far. Well, this brings me into the strategy that I'm talking about. The exact strategy that we're going to be going over in this video is going to be buying shares of TSLY and then utilizing a cover call strategy. Yes, selling cover calls on the TSLY ETF, which by itself utilizes a synthetic cover call strategy. So the way that a cover call works is simply put, you basically pick a strike price, you also pick an expiration date. And then as long as you own 100 shares of TSLY, because when you sell options or sell cover calls, you need to have at least 100 shares. 100 shares equals 1 contract. So now the intricacies on the way that this works. Basically, let's say as of right now, TSLY is trading at $10.99 per share as of filming this video. So let's say that we were to buy 100 shares of TSLY, which would cost us as the investor $1,100 more or less. Now again, the reason why an investor like myself would even want to do this in the first place is to benefit from those massive monthly distributions, which have been pretty good since the inception of this ETF. But again, as I said, selling a cover call is basically shorting the stock and betting that the stock is going to go down because this is how it works. So remember, TSLY is currently trading at around $11 per share, and we spent in theory $1,100 to buy the 100 shares of TSLY. Now what we would do is we would go to sell, we go to call. This is right here on the Robinhood app, but you can use this on pretty much any brokerage. We would then pick the furthest out expiration date, which is 222 days away. The further out the expiration date goes, the more premium that you're going to receive when it comes to selling options. So now what we would do from there is we would pick a strike price around $2 away from where TSLY is trading at currently. Remember, TSLY is trading at around $11 per share. So if we were to choose a $9 strike price, for example, we would be able to earn $2 per share in premium for every single share within the contract, which of course is 100 shares. So altogether, by choosing this contract, we would be agreeing with the call buyer that we're agreeing to sell our 100 shares of TSLY for $9 per share, which would be $900. So now you might be saying, well, why in the world would I sell my shares of TSLY in sometime in the future on or before this expiration date for $9 per share? Well, because the buyer is going to pay you $2 per share in premium, or $200. So basically your break-even price is right where TSLY is at currently. Your break-even price is going to be at $11, which basically means if TSLY trades down even $1 or even $2 on or before the expiration date, in this case August 16th, then you would still be profitable as a call seller. Now on the other side of things, if TSLY was to shoot up to say $12, $13, $14 or whatever it is per share, then at that point your max gain is going to be capped at even basically. Because again, the call buyer has the right to take your shares away on or before the expiration date for $9 per share. But again, you earn the $2 in premium, so it doesn't really make a difference. If at some point the call buyer wants my shares at $9 per share, I already got the $200 or the $2 per share in the meantime, so go ahead and take my shares if TSLY so happens to rally for whatever reason. But let's be real here, looking at TSLY on the max time frame, this ETF has done nothing else but pretty much trade down and to the right, other than a few moments in history for the most part, and in my opinion it's most likely going to continue to do so. So the downside or the max risk of this play basically is that you buy TSLY for $1,100 per share, you sell a $9 covered call for $2 per share, so you earn the $200. So at this case, right in the beginning of the play, you're basically sitting at a cost basis of $9 per share TSLY because again, you bought it for $11, you sold the covered call for $2 per share. So now you're basically into this play $900. Now, if TSLY trades sideways or continues to trade down slowly over the next few months, you will not only earn the dividends along the way, but you will also be able to capture some of that upside from basically the fact that TSLY has been trading downward within the time frame. But again, if TSLY in this time frame was to trade up, maybe past $12, $14, $16, again, anything can happen. Well, then of course, you're most likely going to be forced to sell your shares at $9 per share, which again is basically break even for you. Now, so far over the last year, I've actually personally been utilizing this strategy for my own portfolio. I bought a ton of TSLY at $14 per share a while back, and then sold the $12 covered call a while back. Earned around $200 or $240 per contract off this play. And since TSLY traded down, I was able to capture all the premium and still keep my shares and capture all the dividends. Now what I can do from here is roll over into a lower strike price and basically do the same thing over and over again. Now keep in mind, this strategy is definitely for the dividend investor, the income focused investor like myself that's interested in earning these dividends on a monthly basis from TSLY, which have been again pretty good so far, but not necessarily interested in participating in owning an ETF that's continued to trade down and down and down over time. Now, who knows what's going to happen in the future? Maybe TSLY for some reason will start trading up again, and maybe this whole cover call strategy won't even work as well as it has in the past. But as of right now, it's just simple math. The fact that you can choose different strike prices and the fact that the premium is still pretty juicy. It makes a lot of sense to me why this might be a worthwhile investment for the investors out there, like myself, that are interested in farming this cash flow from the distributions on a monthly basis. But when it comes to owning shares of TSLY and this cover call strategy, would you personally implement a cover call strategy like this with a riskier ETF like TSLY? Let me know in the comments why or why not. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.